everyone, Kevin here, one of your favorite real estate investors on YouTube, and today I've got, well, some news that I don't want to report, but that I have to report. An update to the mortgage crisis. We're gonna start with Freddie Mac's update and predictions. This means we're gonna get the 38th largest Fortune 500 company, the one we heard like about every single day in the 2008 meltdown, Fannie Mae and sister company Freddie Mac. We're going to get an update from basically one of the founders of the conventional mortgage, Freddie Mac. And they're going to give us their prediction on housing prices and interest rates. So if you're interested in real estate, you're thinking about buying, you're thinking about selling, you like refinancing, you're a tenant and you're like, is this my opportunity to finally get into the real estate market? I will give you Freddie Mac's update first. Then I'm gonna talk about an insane new update from the Federal Reserve regarding mortgage appraisals. Absolutely shocking. We'll then talk about mortgage applications and what the heck is going on with home builders. So let's get right into it, because this is the Meet Kevin Report, where I report news that makes you money. All right, I haven't done that intro in quite a while. So, all right, let's get into it. So Freddie Mac just released an update, and their update reads that the housing market will deviate from its typical spring surge, with both home sales and house prices falling due to the pandemic. I mean, I think that goes without saying, but what we want are the numbers. Now, what's also interesting though, before I hit the numbers, is they say undoubtedly the housing market is gonna face its greatest challenge, blah, blah, blah. And then, although the uncertainty of the crisis means forecasts of economic activity are more unclear than usual, in other words, it's like kind of hard to predict what's happening, they expect that most of the economic damage from the virus will be contained to the first half of the year. That is a big statement right there, because a lot of us are thinking, oh my gosh, this is the beginning. We're seeing more and more cases, even though maybe the curve is slightly flattening. We're still at the beginning of this. We haven't even seen all the earnings guidance yet we're gonna get from companies. We're just starting to get releases like from Goldman Sachs and Chase and Wells Fargo, though at the same time, we've got an oil crisis going on. Like, how could this be contained to the first half of the year? Okay, but that is their opinion. So let's just keep going. It's interesting. It is interesting. I mean, remember, 38th largest Fortune 500 company here putting pen to paper, saying they think that the virus will be contained to the first half of the year, the economic impact of it. Going forward, we should see a recovery starting in the second half of 2020, which is very interesting, because if you're thinking about buying real estate, I mean, I'm not trying to sound like a real estate shill here, but that basically what they're saying is you might try to pick up some deals at the end of this second quarter before the second half begins, like May and June, right? Second quarter, April, May, June. Yeah, they're thinking a turnaround might start July, August. Interesting. Okay, now, according to the forecast, now I feel like I'm getting out my crystal ball, but hey, these people probably have a few more researchers in their offices than I have in my office. It's just me in here, okay? All right, here we go. The average 30-year fixed rate mortgage is expected to be 3.3% in 2020, which, by the way, that is insanely low. 30-year fixed rate mortgage is expected to be 3.3% in 2020, and whoa! This is what they're expecting for 2021, that rates will actually decline to 3.1%. That's amazing. I mean, I would probably still refinance today if I was in the position to where I could lower my rate and reduce my monthly payments, because it's gonna give you more cash flow now. And honestly, more cash flow now is just, for me at least, going straight into the stock market and kind of build up the war chest in the stock market for those good deals in real estate. My POV right now is buy stocks at a discount. And if those stock prices are higher come June, come May, sell out of those and go buy real estate at bottom. This sort of weird mixing of the real estate cycle. That's my opinion right now. Trust me, I am full on bullish for real estate. Trust me, like, real estate is my number one investment. I'm a 28-year-old with an $8 million portfolio that I created myself, working hard and grinding as a real estate agent and making money to invest. So yes, real estate is my primary investment, but wow. I definitely am, though, trying to time the market a little bit by buying into stocks and then buying real estate. That's just my POV though. All right, let's keep seeing what's going on here. House price growth is expected to decelerate to an annual rate of 0.4% in 2020. Wow. I don't know if I believe that. they're saying the increase in housing prices is expected to slow down to a growth rate of 0.4%. Basically, they're saying they think in the entire year of 2020, averaging out the down that we're seeing now and the up that we'll see at the end of the year, they think real estate prices are going to go up about 0.5%, 0.4%, which that's really interesting because they did say most of the economic damage will probably happen in the first quarter. So that actually kind of reiterates a little bit of at least my speculation, which in a lot of areas we saw somewhere around 2 to 3% in gains. So I think we're gonna see that 4 to 8% decline. But this is Kevin. So let's say Kevin forecast here, which I believe, that we'll see some kind of rebound. But according to Freddie, I'll use a different color here to indicate Freddie, okay? Blue is Freddie. According to Freddie, they believe that all of this madness that I'm seeing, the strong start to the year, then the decline, then the rebound in quarter two, which I agree with them on. That's why I think, this is the time to buy deals, which is really gonna be like May and June. Maybe, even start shopping right now in April. But anyway, they believe that these prices are basically going to do something like this by the end of the year, to where at the end of the year, we're actually green by 0.4%. That's interesting. Okay, it's their theory. Now, this is also interesting, though. I think this is partially because of the damage that we're gonna see in 2020. They believe that next year, in 2021, rather than seeing any kind of boom in the market, Freddie believes we're gonna probably continue to see this relatively flat growth, and we might only see real estate prices increase by 0.7% next year. But that's actually very interesting that Freddie believes we're gonna see this damage in quarter one, quarter two, then we're gonna see a rebound in quarter 3 and 4, and we'll still average up, although barely, like basically flat, for 2020 and 2021. Now, the rest of their update here isn't really that interesting, so let's move on to the next thing that's really interesting. They mostly just say, hey, you know what? Volume for loans for purchases this year is gonna be less. Next year, it'll be bigger, and it'll be the opposite for refinances. In other words, most people are trying to refinance now compared to next year. All right, I get it. Even though they did say they expected rates to be lower next year, that is interesting. All right, let's move on to the next update. Appraisals. Oh my gosh. So big update here from the Federal Reserve on appraisals. So usually when you get a house, you buy it or you refinance it, an appraiser goes to the house, they measure it, they take pictures of every room, the smoke detectors, they inspect the furnace, they go through the entire property to make sure the bank's not getting ripped off. Well, now the Federal Reserve is saying, we're kind of having issues here with people getting loans, especially because a lot of people don't want appraisers in their houses right now. So the Federal Reserve is saying, you know what? We're now making it so that you could get these appraisals done without the appraiser actually going inside the property. Now, quick note, if you're buying a place, you're probably still going to see that in-person appraisal. This is really just a change for cash out refinances. And the reason that matters so much is look back at the last massive crash we had in 2008. A lot of it was fueled by homeowners doing massive cash out refinances in 2004, 5, and 6, basically taking out the max debt at already inflated property values, trying to get as much debt as possible. And then when property values came down, people were left with this bag of massive debt. And then they'd look around at, well, what did I do with all that debt? Oh, I bought vacations, boats, and RVs. That doesn't do me much good when the market crashes. And boom, big foreclosure crisis of 2008 comes around. So cash out refinances are a big place you usually want to see constraints. Less people doing cash out refinances. This really loosens that and lets more people take on more debt, makes it easier for people to take money out of their places. Now, I also believe this is limited to primary residences, so I don't think we're gonna see a lot of landlords doing cash out refinances without appraisers actually going to the property. Now, I wanna be clear, old school, you used to be able to get these things called appraisal waivers, which appraisal waivers were basically like, hey, you've got so much value on your house, like your house is worth $600K and you only owe $300,000. We don't need an appraisal to feel comfortable. We'll just put it into like Zillow and be happy with that. They don't actually use Zillow, but they use something similar to that to figure out, okay, there's enough value there. We don't actually need to send an appraiser to the property. Well, now let's say you have that $600,000 house. It's got a $300,000 loan on it, and you want to take money out of the property so you could go buy puts because the stock market's going to crash, in your opinion. Fine. You used to have an appraiser come to your house and go through everything. Now they're starting to indicate that, hey, you know what? Even for cash out refinances, we might actually not require the appraiser to go into your property, and we'll just rely on other things like photos or other data or metrics, and we won't actually come visit you because of this outbreak. This is really interesting because it's really starting to loosen the criteria for people getting loans, which means people get more flexibility. People have the ability to get more money in their pocket sooner, but it also potentially exacerbates kind of the mortgage crisis that's happening because now you're having potentially less information provided to appraisers, which means potentially houses are getting refinanced at higher values. In other words, people are sinking themselves into more debt potentially, and you create maybe more of a bubble. It's interesting to me. I also think this is going to be really good for the 3D scanning business. I wouldn't be surprised if an appraiser in the future said, hey, you know what? Why don't you just send me a 3D Matterport scan of your property? And you bought my favorite Matterport camera, the Insta360. I've got all the links for the Insta360 down below, by the way. And you walked this through the property, did a quick little scan, you sent that to the appraiser, and boom, it measures it for the appraiser, and it gives them a 3D diagram of everything that's there. Like, I think that's the way of the future, and this is a sign that we're starting to step in that direction. Although every time I see these sort of lending criteria loosen, I get a little bit more concerned because it could really start inflating values and start encouraging people to take on a lot more debt. In other news, Homebuilder confidence has taken its biggest 1-month dive in history. This is straight from the CNBC here. They've indicated that usually a reading above 50 is positive, and we were expecting the reading to drop to 55, but it actually dropped all the way down to 30 in April, which is a huge plummet. This does not surprise me at all. New construction is the worst thing to buy at a time like this. And not only that, but I drill into all of my course members in my real estate investing program and our live streams every day. The market's open at 9 a.m. I drill new construction. Only buy it if you can't find a wedge deal and if the market's going up. But in a panicky time like this, you're overpaying, you're paying above the market value, and the market's potentially falling. This is too turbulent of a time to buy new construction. Somebody left me a comment the other day and said, how do I short real estate? And I said, short home builders. Now, some of this kind of news might already be priced into the market, but oh my gosh, the only type of real estate I would consider buying right now is anything below market value. Just because Freddie says, hey, things might be flat this year and next, even though we'll see some volatility, I would still rather buy below that line. So do whatever you can to buy real estate below market value right now. Take advantage of the fear that's out there. Don't get ripped off. Don't pay market value. Join me in my programs down below. Get your quote for life insurance in 5 minutes or less. Get your 2 free stocks with Webull if you deposit just $100. And of course, subscribe to the channel, and we'll see you next time.